If everyone would please move towards your seats. Please have a seat. Silence your cell phones and devices. At this time, I will call this November meeting of the Interim Joint Committee on Banking and Insurance to order. Madam Secretary, please call the roll.
Senator Rocky Adams, Senator Douglas, Senator Girdler, Senator Howell, Senator Neal, Senator Schickel, Senator Smith, Senator Storm, Senator Turner, Senator Yates, Representative All,
Here.
Representative Bentley, here. Representative Bray, present. Representative Duval,
Here.
Representative Fraser Gordon, Representative Gooch, here. Representative Justice, Representative Lewis,
Here.
Representative Lockett, here. Representative McPherson,
Here.
Representative Pollock, Representative Rorix, Representative Roberts,
here.
Representative Smith, here. Representative Stevenson, here. Co-Chair Carpenter, Co-Chair Meredith.
Here. We do have a quorum and are duly constituted to do business this morning. I think the first order of business would be to approve the minutes from the October meeting. Do I hear a motion?
Motion to approve.
Motion from Representative McPherson. Do I hear a second? Second. Senator Douglas, was that you?
Yes, sir.
Second, Senator Douglas. All in favor of approving the minutes, say aye.
Aye.
Minutes are approved. This time we will move right into our agenda for today. First on the agenda will be our update from Kentucky Farm Bureau. If you all would please come to the table, identify yourselves for the record, and then you may proceed with your testimony this morning.
Good morning, Mr. Chairman. I'm John Sparrow. I'm the CEO of Kentucky Farm Bureau Insurance Company.
John, pull that microphone just a little closer to you if you don't mind.
There you go. Better? John Sparrow with Kentucky Farm Bureau Mutual Insurance Company, and I've got some colleagues here with me, and thank you to you and the committee members for having us.
Good morning. I'm Paula Smith, and I'm Vice President of Legal Services for the insurance company.
Good morning. Anne Marie Franklin, Governmental Affairs Manager with Kentucky Farm Bureau Mutual Insurance.
And again, thank you so much for the opportunity to sit down and chat with the committee. Our goal today is to share a little bit of what's going on, somewhat a state of the union of both Kentucky Farm Bureau Insurance and our industry here in Kentucky. I'd like to lead, of course, with thank you for your service. I think you might know, as Kentucky Farm Bureau Insurance Company, you would expect us to say that we're here to service and protect the assets of the people of Kentucky, and that's one of the things that we are completely passionate about, as you all, as committee members and chair, are serving the people of Kentucky as well. So for this moment, we'll share a bit of the same space and talk about what's going on in the insurance industry to our constituents out in Kentucky. For Kentucky Farm Bureau specifically, when you collect all of our premium that we do, we'll represent approximately 20%. And if Mr. Chairman, if it's pleasing, I'm going to talk in rounds today, but approximately 20% of the business in Kentucky will fall through our doors. That gives us over 470,000 members, membership families that we serve, and over 1.4 million policies in force. With over 900 of that being in the auto line, 900,000, one of the things that's plaguing the automobile line right now, which is also plaguing you all in your personal lives away, it's labor, supply chain, and inflation. We've seen that really press on us over the last 3 years, but all of them are ebbing and flowing, but they all are remaining significant in our ability to serve our members with the services they need to fix automobiles. That also spills over into the property lines. And without laboring on that too much, I'll just remind you of some experience that we've had over the last 3 years, all the way up into today. Starting back in 2021, I chatted with this group last year about the tornado events. At that point in time, that was one of the most significant events that hit our state of Kentucky with natural disasters. That was, a 220 some odd $1 million event for just our organization. So if you imagine for the industry in Kentucky, it was a significant financial impact, and that was fraught with labor, supply chain, and inflation, trying to mitigate and fix all that back. Then in 2022, that was in December, but then in 2022, we didn't have any major catastrophic events or weather events in the state of Kentucky. There was a lot of weather, but relatively small, but we were still fighting uphill in getting automobiles fixed, properties fixed, being able to get materials, and again, labor shortages. And there might be a suggestion that stuck. That was kind of an aftermath of the COVID experience that we started back in 2020. People kind of choosing different paths in their career. Well, we found that a lot in the labor market, fixing automobiles, fixing homes and properties. So fast forward into 2023, if any of you all remember Friday, March 3rd of 2023, you might remember the wind was blowing excessively hard through this area and through where every one of your constituents live. Every county in Kentucky experienced high weather event. In where I lived in Louisville, it sustained itself for quite some time. I'd say 6 to 8 hours at 70 to 80 mile an hour gusts, but sustained winds. And you might recall that day. The reason I share that with you is that has now turned into the largest event, the largest weather event in the state of Kentucky. It wasn't catastrophic. It didn't cause a lot of death and destruction, but it caused an unbelievable amount of loss experience. And to date, your largest domiciled insurance company in the state of Kentucky, to date, it is the largest event we've ever had in the history of our company. That one loss on that one day was $455 million. That is more than double the 15 months earlier than that, the most well-storied weather event we had with the 2 tornadoes that came through in December. That was well documented. It was shared all across our nation. We had people seeing videos of it outside, overseas, and reaching out to us about it. But that little event was half of the financial impact to our organization, as was March 3rd. So in a 15-month period, we had unprecedented weather events from December of 21 to March of 23 in Kentucky. And then that was followed in June by approximately a $90 million event, which was a hailstorm. Hail is we all know it, we all understand it. I hope it hasn't affected each one of you all, but that was in the Richmond area. Hail hits all the time, but when it comes at that level that it came in Richmond, that is significant. And we'll hold a significant market share in the auto line and the property line. So all of the industry, all of our constituents and friends that serve alongside with us as competitors, that was another big deal for them. So with that, we want to be mindful of the things that we're still challenged with. As an organization, as an industry, and for our constituents out in the state, we're recognizing that cost is going up. One of the things that when you're chasing profitable experience, the loss history impacts that. We know that. That's what our bread and butter. We understand loss history. But I want to share with you a couple other things that are plaguing our industry. Not only the people of Kentucky in insurance, but our nation. And that is reinsurance. Reinsurance is how insurance companies, of course, insure themselves against catastrophic loss. It's very elementary in that you buy risk to cover major events. But with that, you carry a deductible, or we call it our retention of that loss. And most folks in our major carriers that operate across the United States, they have major retention and major deductibles, so to speak. Kentucky, we have a much more modest retention and or deductible because we just operate in Kentucky, and our premium dollars are just in Kentucky. So when an event hits, it's very substantial to us, and it is to our competitors as well. But reinsurance costs, both for them and for us, are rising in double digits. I don't think it's my role necessarily to this committee to disclose what percentages those are, but I can share with you they're significant. And that is our members for Kentucky Farm Bureau and its competitors. You pay for your reinsurance, you buy that coverage with the premium dollars that your members or your clients or your customers pay you. In essence, you give us $1, we're going to peel off a piece of that and send it to our constituents, our partners at Lloyd's of London. We're going to send it to our partners over in the Bermuda reinsurance markets, and they're going to cover us holistically if we exceed a certain loss experience. That's going up significantly, and that affects pricing, that affects our ability to make profit, and that is affecting, again, not just Kentucky Farm Bureau, but anyone in the P&C insurance space. And I wanted to make sure you all recognized that. But with that, I'll share with you our organization is financially strong. We have a surplus position, or perhaps a more elementary way of saying is our savings account is firm. It's very strong. Our financials are very strong. Our premium income is very strong. We measure leverage ratio. We want to have more surplus than we have premium income. And as a good rule of thumb, it's not necessarily a need, but we choose to operate with more surplus than we have premium income. And that shares with both the industry, our DOI of the state of Kentucky, and anyone to judge us like AM Best, that we are financially strong and well conservatively run. So we're still in that position. I share that with you to say that that has been impacted both from loss experience and without raising hands here in this room, I would dare say most of us with our investment portfolio, it's not been doing terribly well over the last many years. Well, that's what the industry is being faced too. With we are heavily invested in bonds, modestly invested in our stocks or equities, but in this market, we're not making really great returns and on our investment portfolio, but we're also losing on our loss experience with weather, labor, supply chain, and inflation. I'll share with you with great confidence, we will be able to get to the other side of this. This will be something that we'll all have to share together as both consumers and business planners. And I just wanted to share that little State of the Union of Kentucky Farm Bureau. Be happy to answer any questions, but before I do that, if I could just share with you all, I know that Paula Smith and Anna Marie Franklin, I know they represent us here. I know you know them, and I just want to tell you that back home, back in our state office that I spend most of my time, they really keep us up to date and keep us paced, and I want to thank you all for your relationship with them. We hold them in high esteem, and we appreciate you all working alongside them. But with that, Mr. Chairman, I'd be happy to answer any questions.
Thank you, John, for that update, and you do have wonderful representation here in Frankfort. We appreciate the opportunity to work with them on it.
No.
Do have a question right now from Representative Gooch.
Thank you, John, for that presentation, and I understand the things that you are we're talking about as far as reinsurance. We know that goes up when you have all the catastrophic events that we've had across the nation. What I have been hearing that many companies are looking at making a change in, for instance, homeowners insurance, where generally most folks that have a home that's well maintained are able to purchase replacement cost policies. And I know that one of the most significant things that can happen to the average consumer is having to replace that roof or whatever. Everything's expensive, replacing heating and air units and all that. But the roof is a very expensive item to replace. And I'm being told that some companies, maybe even yours, may be considering if a roof is over 2 or 3 years old, possibly adjusting that using actual cash value instead of replacement cost. And I'm a little concerned about that. I was in the insurance business for years, and sometimes I admit I had some customers who felt like that it wasn't their responsibility to replace the roof. They'll just wait until a storm happened, and then they could get it replaced. And a lot of them are very good at doing that. But could you just comment on that aspect, whether you're considering that or whether you think other companies are considering that as well?
Thank you for your question. That's a very significant strategy that is playing into Kentucky, certainly Kentucky Farm Bureau. As it is somewhat complicated, so if you bear with me, I'll walk you through an illustration. I'd also say, if any of y'all ever, you can only imagine, the what ifs in loss experience in the insurance industry can get kind of dangerous. Like, what if this happens? What if that happens? But if I could give you a high level view of where Kentucky Farm Bureau is going with your question. And I think the question is, are we going to be an actual cash value organization on roofs, or are we going to be a replacement cost organization? As of today, we have primarily replacement cost on our policies. But we are rolling out through renewals, and we have to notice our members 80 days ahead of time in writing, but we're moving to actual cash value on our storm losses. As an example, it's not actual cash value if your home gets blown away, or a tornado, or a water damage, or a theft, or a fire. It's strictly on wind, hail, and wind. Which is plaguing the industry, quite frankly. And Kentucky is a destination state. When a storm comes through, it's a destination state for roofers. You all know that. If you've ever been around, trucks show up from everywhere, every corner, because this is a place they can come and get replacement cost coverage and repair roofs. We've seen in other states movement with other organizations that went to replacement cost. The way we're doing it is we're going to we feel certain, as I hope you do, that roofs are a deteriorating product, much like car tires. We don't cover car tires. That would be silly because they wear down. Roofs wear down as well. They are primarily a shingle roof. If you go look in a gutter, asphalt is trickling off of those all the time into the gutters. Well, that's a deteriorating product. So with that, we're going to, after you go through the renewal cycle, i.e. if you haven't been caught in the renewal cycle yet, we'll start first of the year, and by 2025, all of our policies at the homeowner line will have this actual cash value coverage. We're going to have full replacement expense on the labor. We're just going to depreciate your materials. So if your materials come in and they tend to be half to 40%, it just kind of depends on what the total loss is. Of course, labor you can't depreciate, but we will depreciate the materials. And we feel like that's a fair way to do it. And the depreciation is on a table, and it depends on the kind of roof. If I could share with you a cheap roof, and let's don't go down definition of what a cheap roof is, but they are cheap roofs. They're expensive roofs. Tend to be the metal roofs. They might deteriorate just 1% a year. I mean, you'd say it's not much depreciation, but a cheap builder grade, I don't want to define that on somebody, but a low end roof might deteriorate 3% a year. So, and we'll max back in Kentucky for Kentucky Farm Bureau, we're going to max that out at 75%. So we'll always pay you, even if you have a 30, 40-year-old roof, we'll pay you 25% of the value of that roof in the event you have a claim. But now if it's a metal roof, it might be 80 years, and we'll pay you 25% of it. So it's not all losses, all roofs aren't created equal. We have seen in other states, and I dare never mention or direct or suggest what our competition's going to do, but I can tell you in other states that this has served that both the members and the insurance companies that have gone in this direction, it served them very well. It really changed the roofing industry. In other words, it wasn't, our friends to the south in Tennessee as an example, they don't have cars lining up in neighborhoods from out of state trying to get roof jobs, because primarily everybody down there is either ACV or high percent deductibles on roof claims. And perhaps you just asked me, are we going to do it? So forgive me if I'm over complicating the question. But yes, we are moving to ACV, but all ACV is not created equal. That's why I wanted to share how we're going to do it.
Follow up, Representative Gooch.
Yes, and you mentioned that is related to storm-related claims or whatever, which would indicate that beyond the roof, you could be talking about like siding or gutters or that sort of thing. Is that also, you're going to have other things?
It's not.
Okay.
It's roofs.
Okay.
Siding doesn't deteriorate like a roof does. Gutters don't deteriorate like a roof does. Lawn furniture doesn't deteriorate like a roof does. But roofs, I feel very comfortable in saying they are designed to deteriorate.
Thank you, Mr. Chairman.
Senator Girdler.
You're singing from my hymn book, but when you said wind, you know you're in Frankfurt, right? And the wind blows here all the time.
Yes, sir.
Anyway, the dates that you mentioned, I know everybody gets sick of hearing this. I was in the insurance business 43 years. March 3rd, 2002 was a big date.
As hell.
Yeah.
I've been
HELL and HAIL in Pulaski County. So, you know, and then June the 3rd, about 1998 or somewhere in there, we had, they call them derechos, or what's the wind when it comes down, stays and...
severe convective storms.
Yeah, but they have a name that this dumb country boy can't think of, but it's 80-mile-an-hour wind that just comes down and stays down for a while, which is, so we had one of those in Pulaski County too. So I can go and recall all these dates. This is for those people that think this is a phenomenon that only happens now. No, it happens all the time. And our rates have, when I say our Shelter Insurance is who I work for. I've always said, and Representative Gooch is right, people wait for the first windstorm and they get the roof replaced. And we get calls all the time. They come out of Nashville like crazy. You know, I've had people look at my roof and say, you got hail damage. And I said, boy, you got the best eyes in the world. If you can sit down here on my road and look and see if I got roof damage. The only thing worse than them is lawyers. I mean, anyway, point being is this. If Farm Bureau does it, or if State Farm does it, all right, you're the dog. You're going to wag the tail. If some other company does ACV other than you two, that's the tail wagging the dog. And it ain't going to happen. And I'm glad to hear that you all are looking at. I live 3 miles from the president of Farm Bureau. Is till January 1st, Mark Haney. That hailstorm hit him and it hit me at the same time. First time I ever had a hail claim in all my years, but I live on the lake, and anyway. I am glad to see that Farm Bureau is doing this. Now, the consumer is not going to be glad. The consumer is going to be glad when you get the premium, and it's not $4,000; it's going to be $3,200. But that reinsurance, $440 million, and I know y'all got a retention and all that. I got my bill the other day. My homeowners went up $800. And the only reason I didn't throw a fit because my son-in-law bought my agency. And so, but if you all do it, everybody else will fall in line. They have to be competitive. But I'm glad to hear that you're going to ACV. Now, I did hear this. You're all going to wait, if I remember correctly, you're going to wait for 7 years before you start taking ACV.
Well, that's a good question. You start counting depreciation. Depreciation starts happening the day you put your roof on, but we are not going to start applying it until year 7. And there's industry averages, or there's industry data that would suggest, both by the roofing industry and by our studies, that in year 7 is when it becomes of significance, that changes the value of the roof. So we're trying to do it appropriately. Some of our friends are in the business are doing it year 1. There's also some that are doing it further out. We're trying to apply what the actual industry roof, if you read them, most every one of them have a 7-year or 6-year warranty. So that's significant. They make their own product, and they're putting that kind of backing on it. So that's why we chose year 7.
Just one quick follow-up. What percentage? I know that if you go up over 25%, you got to give people, or change the policies you're talking about. I thought it's 75 days. You used 80. I'm assuming you're all using it for protection.
75, but we put a cushion in.
We put a little cushion in it.
Yeah, that's what I was
Member
thinking.
friendly.
Yeah. What percentage of is most of the industry looking at in Kentucky of going up? I know they need more than 25%, and I know probably, I know they're probably going to do one in March or April and do another one the next year, because if it's 25% in a year's time, I'm assuming that they'll do it twice and do 12.5 each time or something. What percentage are you all looking at of having to have your savings account stay the same? What percentage are you looking at?
That's a loaded question.
Yeah, but I'm trying to find out for shelter so I can tell them.
One of the things I'll share with you that I'm very open about, we don't tend to take our indications. In other words, there's actuarial indications that would suggest a very large rate increase, but as a member service, as a financially secure organization, we want to make a modest profit. I think we can all agree that if you're in a retail market of insurance, you need to make money to stay in business. You can't just give away and lose every year. But we choose a much more soft path for our members. Oftentimes we see filings where people are moving to what they would call rate indications, what they need to make money right now. and Kentucky Farm Bureau will take a much more, there will be increases, not just with us, the entire market. It's an open book. You can go look and see loss experience. It's a rare organization that's making money right now in the insurance space, not just in Kentucky, but across our nation. And so there is rate increases coming. We will strive to be as modest as we can. When we budget and plan for a year, we don't budget double-digit profit. We want to remain financially strong and make a little bit of money doing it. And that's the only way you can stay financially strong. As a mutual company, wholly owned by our members. But telling you a number probably wouldn't be a fair answer.
The reason I ask, it's going to be significant. It's going to be huge for everybody.
You mentioned the 25%. You're describing if you keep it under that, you don't have to pre-notice.
There you go, 75 days. That's the reason I'm saying the companies will probably.
But remember, if you just have one policy go over 25%, and we have 1.4 million policies.
Right.
If one of them goes over 4%, all of them are in pre-notice, and we don't do that. It's rare. So we're in a rare spot where we're noticing them primarily, Senator, because we're changing their coverage, not because of the 25%. It would be a rare policy that would go up that much in our shop, but it happens. But we have to pre-notice because we're changing coverage, i.e. moving from replacement cost to actual cash value. Great comment.
Representative Hall.
Thank you, Mr. Chairman. I'll be brief. I know we've got a packed agenda. Mr. Sparrow, thank you for your time today. Thank you for the presentation. You know, we're seeing across this country, Kentucky's not immune to the increase in natural disasters, some of which scientists have pointed to are caused by climate change. And in the states where that's most prevalent, like California, Florida, Louisiana, we've seen a number of insurance companies decline to renew policies in those states. Now, as Kentucky's had these significant events, including the flooding that you didn't talk about in your presentation, which also was a very significant event, the significant events you've talked about, are we seeing any insurance companies, not you all because you all are based here, but some of your competitors, are you hearing about any of those insurance companies considering not renewing here in Kentucky?
I'd say major carriers I haven't heard that are leaving Kentucky. Major carriers have left some of the coastal states. I mentioned reinsurance. Reinsurance is going to drive a lot of that, and then bottom line experience is going to drive a lot of that. The reinsurance market is it's completely changed. When I sit and talk to our constituents at Lloyd's, we have to go there to meet with them. They won't meet with us here because of tax consequences in the United States. So we go over there and talk to them, and the very plain conversation is that they call us the Midwest. Kentucky, we can make arguments, but that's what they call us. It's kind of like this big football-shaped area that goes out west all the way up to us. They say that we are the new hurricane like loss experience. The coast is plagued by hurricanes, and that's where reinsurance and retention dollars for our big carriers that operate in Kentucky, that's where their dollars are going, because they have to have huge retention because they got all these coastal coverages. And then in Kentucky, we don't have coastal coverages, but the reinsurance market is saying, well, you're now the new coastal area, and it's severe convective storms. Mm-hmm. And what you'll see in the industry is that's tornadoes, that's hail, that's wind. And, you know, if you look in our history, I contend it's a cycle. They say climate change, new world, this is where we're going, it's all our fault. Forgive me for, that may be a political statement, I apologize. But I will tell you in my 34 years, just as our Senator Girdler shared, I can name the cycles of these things. and the time period I experienced them to be in. We're in one now. But we will have in my opinion, and I'm no forecaster, but if the past is any predictor of the future, we'll have sunshiny days for a period of time. I don't know if it's going to be 24, but it certainly hadn't been 21, 22, and 23. But I would recall the latest we saw this was 08. We had a hurricane in Kentucky, Hurricane Ike, and then in 09, the freeze of West Kentucky, and y'all were out there. And then 10 and 11 were kind of a mess, and then 12, we all remember the West Liberty tornado, which also was wind and tornadoes across the state. Well, that was 10 years ago. And then we experienced the real thing that challenged the industry up until 21 in Kentucky was labor, supply chain, and those kind of things. It's interesting. Car market, everybody was chasing profit in the auto market 15, 16, 17. And then we started making money in it. It had nothing to do with weather. It was just labor, supply chain. People were driving crazy. And then when COVID came, everybody was making money. And now we're back to people are driving fast and crazy, and we're fighting the labor supply chain. If we raise our paid labor rate in fixing automobiles in a body shop by $2, that's millions of dollars to our organization. And so we try to keep prices low, but yet we're in a market where go in and try and get your car fixed. They might get the part, but they don't have enough staff to get you in fast.
But you're unaware of any carriers or insurance companies at this time that are planning to pull out of Kentucky?
No, sir.
Okay. Thank you.
I hope they don't.
Me too.
Thank you, Mr. Sparrow. Thank you, Paula. Thank you, Anne Marie. Appreciate you all being here and the very informative presentation.
Thank you.
Thank you.
Next on our agenda, I want to call up our folks representing Fifth Third Bank. If you all would come to the table. Introduce yourself for the record when you get to the microphone. Make sure the microphones are on. And then you may proceed with your presentation.
Good morning. Kimberly Hallbauer from Fifth Third Bank. I'm the regional president for the state of Kentucky.
Hi, Nick Potziadley. I am the Senior Deputy General Counsel at Fifth Third Bank, and here and glad to be here. Thank you. I do have some slides. I don't know if they're going to be pulled up or not. Thank you. Oh, thank you. Perfect. And excuse me, despite the earlier comment about lawyers, I do have to do the one lawyerly thing and say that, while we are representing Fifth Third Bank today, these views are on behalf of myself and the Bancorp and on Kim's behalf. And the slides have all been pre-cleared and have gone through SEC compliance so that there is nothing that is a forward-leaning statement here that would be market moving. So this is all public knowledge. So just to clear the
Appreciate the disclaimer.
I have to. It's the lawyer in me. It's like second nature. But thank you very much. So there's the cautionary statement. I will pain you. You can read that by yourself. But thank you for the opportunity to testify. I really appreciate it. Thank you, Chair Meredith, and all the members for being here today. This is a great opportunity for Fifth Third to talk a little bit about ourselves and why we're here and what we do in Kentucky and across our footprint. So first off, Fifth Third, is a regional bank, which right now has been really caught in the media is a negative thing. And so I'm going to dispel a lot of those myths today as we talk about what's going on in the marketplace and why Fifth Third is differentiated from a number of banks after what happened in what we call colloquially March Madness, where you had 3 regional banks fail. So number one, Fifth Third, we're about a $210 billion assets in total organization. We have retail footprint in 11 states, including Kentucky. We are also a commercial bank that operates across the entire footprint of the United States. And we also have international operations as well. So we are well positioned in that. So, but really, Fifth Third is focused on three things, and you see them on the slide right now: stability, profitability, and growth. Number one, stability. We want to talk about why we are more stable than any of the other regional banks, and I think this is really important given where things happened in March, where you saw the failures of Silicon Valley Bank, Signature Bank, and then First Republic Bank. All three of those banks, while similar in size to Fifth Third, were completely differentiated in their balance sheet makeup. Most of them were made up of uninsured deposits from large, essentially venture capital funds that had put money into those operations for leverage to move deals forward in Silicon Valley. As a result of that, when one or two of those investors decided to say, "Hey, everybody pull out; these banks are no longer stable," they had a run on the bank. And that was, I think it caught everybody off guard, including the federal financial regulators, the FDIC, the OCC, and the Fed, who have a lot of questions to be answered as to why they let such concentrations happen. We at Fifth Third are different. We do not have any concentration risk in any single one market share. We are the lowest holder of commercial real estate portfolio across all of the large banks. And then we have a very diffuse, differentiated stack of loans and leases and deposits from a varying sector. So no more than 9% in each sector, which differentiates us. And that gets to our point on stability. We also were the first bank in the last quarter to grow deposits. We grew deposits by $3.1 billion last quarter. Most other banks saw a negative outflow of deposits in that quarter. And a lot of this is a flight to stability. People are coming to Fifth Third because they see our core makeup, our core state footprint, and understand what we're trying to do, which is to bank the middle market and to bank industries that otherwise wouldn't have capital from the large banks or community banks who couldn't meet their funding requirements. Profitability, obviously, we have to be profitable shareholders, so that's an expense play. We try to keep our expenses lower than anybody else. Our efficiency ratio is very good, and we continue to maintain that discipline there. And then growth, we are always investing. We are buying fintechs that we think that will help add value to our customers. We've invested in our treasury management business, which a lot of people don't think of a bank as somebody who does treasury management, but we in a lot of our corporations that we work with, we run their accounts payable, their accounts receivable. We handle cash flow management, and Armored Trucks even is a partnership to make sure that they have the cash needed to run their businesses. So kind of a little bit of a backgrounder. Now, too, I'll move to kind of the current banking issues in the macro sense. Obviously, there are three tiers of banking in the United States. There are the money center banks, which we also call GSIBs, or globally systemic important banks. The regional banks, which comfortably fit in the middle, and then community banks, which would be generally anybody under $10 billion in assets, but more likely under $1 billion in assets. Those community banks really kind of run the bread and butter of what goes on, but the other tiers of banks do things that the community banks unfortunately can't do because of their balance sheet. So a lot of times we do a lot of what I just talked about: treasury management, middle market, loan securitizations, and more sophisticated products than something a community bank can offer. But then the money center banks are international banks. So they're the ones who are market making. They're doing broker dealers and other things that we're just not involved in. And that's why there's a different risk category. However, the current environment in Washington right now is changing the way that banks are going to operate. The regulatory changes that have been imposed on essentially all banks that are offered right now are going to cause dramatic changes. There are changes to the capital rules, which is called Basel III or Basel IV, depending on how you look at it, or the Basel Endgame, which is an international agreement we entered into in 2012 that the Europeans have agreed to. The Americans, now we have finally agreed to those standards. Those standards are going to change the way that we hold capital on the balance sheet. And I think the regulators have recognized the complexity of this and have extended their comment period. They were initially supposed to be comments due in November 30th. Now they're pushed out to January. But a couple things here that we have is us as a bank looking towards these. We know that the standards are going to change. We're going to have to hold more capital. We're going to have to hold more liquidity. As a result, we have done things on the right column here, which is we are looking at reducing our corporate banking relationships. So if, for instance, you are just a loan customer but don't have any deposit with us, we'd rather have both relationships together, and we might exit that. We've reduced auto and mortgage originations across our footprint. We used to do national. Now we're kind of east of the Mississippi and not going to look to expand those businesses because of the increased capital. We had a brand new, right before these capital rules came out, we had a brand new mortgage warehouse business where we would lend to the non-bank lenders who do mortgages. We exited the business because capital prohibitive would not work. Dealer floor plans the same way, financing auto dealer inventory, we've left that. And then we've reduced our production in what we call dividend finance, which is a solar lender that we acquired last year. So these rules have real implications for us, for community banks, and for the money center banks. And so you'll hear more of that as these rules continue through the process. We are continuing to manage our balance sheet in accordance with this, which is essentially we're not buying back any stock. We are staying pretty much firm on our dividend that we offer, and then we're hoarding the cash to increase our capital balances. And that's where we're going to go long term. And I think you're going to see this across the cycle of all the banks in the industry. Obviously, these are the things that we've invested in and will continue to invest in while we continue to hoard capital. Branch network, we are trying to build our branch network up and optimize it to where we are, which can be painful and sometimes because you close branches in one area, open in another, but we always do it within a mindset of providing all the consumers opportunities to move to the next branch or to find another solution before we close a branch. So you can see here's our footprint, and then you can see also the dots that kind of cover the gray areas are our national footprint, where we have loan origination offices, but not necessarily branches. Our branches continue to kind of run through what I like to call the slash from Florida all the way up to Michigan, and we continue to outperform, I think, our market peers in these industries and in this market share. And then, obviously expense management and talent capabilities. I would say the biggest challenge we see going forward is not the regulations, which we'll meet. We'll figure it out. We'll figure out how to deal with that. Not new law changes. It is workforce development. We live in a footprint where a lot of new jobs are coming on board from a manufacturing perspective. You think of what's going on with the Intel plant just south of Columbus, north of Cincinnati, where we're based. They're going to need tens of thousands of employed skilled workers that we just currently don't have. I think the same thing happens for all of the industries we bank. You think of electronic vehicle plants that are coming online in Bowling Green or other places in Kentucky. They're going to need workers that have the skills and the ability to do this job. And we need to make sure that we're importing the workforce talent necessary to meet and sustain the needs of these large operations. The domestic onshoring of big manufacturing is real, and it's here today. And we're probably a little bit behind, but we need to be thinking about how we develop that workforce and we sustain that workforce in the long term. So with that, I think the bank, Fifth Third, we're well positioned to navigate everything. We have a balanced growth opportunity. We are constricting lending in certain places, but we're committed to Kentucky. And I'll turn it over to Kim, who is our Kentucky regional president, who can tell you all about the things we're doing at the Kentucky level.
Thank you.
Kim, grab your mic there. I think it's off.
Oh, sorry. Okay, thank you. So I do want to thank all of you for your service as someone who's been a part of the state of Kentucky, the Commonwealth of Kentucky, for the past 30 years. That's why I'm here. That's why I made the decision to leave corporate headquarters to come to Kentucky to make a difference. And when I think about what we're doing, part of our presentation today really came about because I think one of the things we have to remember in the Commonwealth of Kentucky is the banking ecosystem is important, from the community banks, the credit unions, all the way up to the money center organizations that exist in our state. Why is that important to us? Because in order for us to have economic growth, we have to be able to deliver for all of the types of industries that exist inside of our state. Without the opportunity to have banks like Fifth Third and others in the state, we don't have the opportunity for Fortune 500 companies or emerging businesses to be able to continue to do businesses. So I want to make sure that, if nothing else, you leave today understanding that regulatory issues are real for all of us in the financial sector, and also that the ecosystem of banking in the state of Kentucky is important to have all areas represented. The community banks can't do it alone, the regional banks can't do it alone, and the money center institutions cannot do it alone. But all of us together in this state make a difference. That being said, I would also say that the resources that we have and that we invest in the Commonwealth of Kentucky should not go unnoticed. Today, we have over 500 employees that live, reside, and work in the state from Fifth Third Bank. We have 69 branches, 2 towers that house our commercial and wealth divisions, as well as a data center that exists in the Commonwealth of Kentucky. That all drives to making an investment of about $1.7 million this year in philanthropic efforts, and about $1 billion when we look at small business lending, mortgage lending, and community-based lending that we are doing throughout the entire Commonwealth. So I share all of that with you today because what I want to make sure is that throughout the state, we all understand that the importance of having everyone represented is meaningful. I want everyone to feel good about the strength of Fifth Third Bank, as well as some of the other regional banks that exist out there. And just know that in order for us to be successful, it's important to have both our 120 banks that exist that are headquartered in this state of Kentucky, as well as having others that have made significant investments in this community to make an impact and a difference for our people and for our opportunity to grow. As I like to say all of the time, in order for us to win, it's very, very simple. We all win together. When Kentucky wins, we win. And sometimes when we think we have to go outside, it's wonderful that we want to support other people's economies, but I believe as a Kentuckian that we should support our own economy and make sure everyone has the opportunity to be successful. Thank you very much.
Thank you all. Representative Smith, I think you've got a question.
Be real quick, Mr. Chairman. Are you in the middle of discussions on crypto?
I think crypto, excuse me, make sure my mic's on. I think crypto is kind of an enigma right now. It is out there. We don't have any position in it. The federal regulators are not necessarily fancy by the idea of us being involved in it. We continue to look at it from the innovation side of crypto, which is essentially the blockchain and the ledger, but we are not necessarily invested in crypto or are entertaining any kind of acquisition in that space.
Do you know if your banks are using it as a collateral with your loans, or do you know if that's a practice?
No, we're really doing nothing other than watching and studying. So we do have customers from time to time that will ask us if we are able to invest part of their portfolio into cryptocurrency. It's just, it's beyond our risk profile from an investment perspective. So, but it's something that we're constantly evaluating. As this continues to take shape in the future, I think there probably is some space that it will exist, but at this point in time, there is nothing we are doing specifically with cryptocurrency.
Okay. You're aware of J.P. Morgan, the large banks that are involved, that is utilizing it. Is that
Yes.
Is that a concern to you?
Not at this time, no. I mean, again, that's really the difference, and I think Nick did a nice job of kind of describing those really large money center financial institutions are going to have different risk appetites and profiles than what you're going to see in a regional bank or a community bank. So where we sit today, again, it's something we'll continue to evaluate. We certainly would not say that we'll never be involved, but at this juncture, it's just not something that we feel is the right risk profile for our organization.
Mr. Chairman, one more. I guess my primary concern is in the last year I've seen ATMs go up in our local stores for crypto, for Bitcoin. So I'm trying to get a feel in each one of our meetings where our local financial institutes are, because I believe it's existing and it's being used probably amongst a lot of your customers. And so you've answered my question on using it as a for financial reasons. The second, I'd like to challenge you to look into our community colleges for your workforce. We're starting to drive it more towards vocational and finding job-ready programs. And I think that there would be an area for training that you could utilize young people through schooling that could actually work at your bank through the training process. Our dual credit hour program is really flourishing, I believe. And I think there's a strong emphasis in looking into vocation that way. So I would encourage you to look at your local community colleges, maybe for a future workforce. But anyway, I appreciate it, Mr. Chairman.
And thank you for that. We certainly, especially in our retail space, we have many college students that are employed with us during their tenure in school. We hire part-time people to work in our retail locations, and certainly welcome the opportunity to partner with any organization on the college level, because our workforce issues are real, like many of yours.
And thank you all very much. I would be remiss probably if I didn't make a somewhat editorial comment, and I think it goes to the point of what Representative Smith has mentioned in multiple meetings throughout the year, and certainly, and as we've continued to talk, there's a big concern about the crypto ATMs that are popping up and the unregulated nature of what they are at this point. But I think it's important. We've heard from the community banking marketplace in Kentucky, and now we're hearing from the regional banking marketplace that is a risk that most of these groups at that level, that middle tier, and at the community bank level, are not comfortable with at this point. And I think it's very, very important that as we think about that, we also say to the federal regulators out there who are not watching today, but to put on the record that there is a big difference between J.P. Morgan Chase and Bank of America and those big globally significant banks and what our regional and our community banks are doing from a risk profile standpoint. And you brought up Basel III and Basel IV, and I have to say, should those things even apply at the regional bank level and at the community bank level, or should they just apply at those globally significant institutions? And so appreciate that discussion, and I just had to editorialize on that just a little bit with regard to the federal regulatory marketplace.
Yeah, no, appreciate that, Chairman. And I would say that I think the biggest thing to watch, obviously I told you the comment period is extended to January 14th. But watch what the banks say, because the way that they have constructed these capital rules will change the way that banks operate. You will move, for the concerns on Bitcoin, think even larger scale, you will have banks who no longer hold mortgage servicing rights. They send that to the non-bank space. And so, Fifth Third originates a mortgage and sells it to Rocket to handle the rest of it. That has reputation risk for us and others, but you're also consolidating that out in the other marketplace. So there are a number of really nuanced things in these capital rules that are going to really change the way banks behave at a macro and micro level. So something to just be aware of.
Thank you all very much. Appreciate you being here today.
Thank you.
Next on the agenda, we want to call forward Ms. Marnie Rock Gibson, our acting commissioner of the Department of Financial Institutions. And Marnie, we want to welcome you here today Those of us who have been on the committee for any length of time, you are a familiar face to all of us here, but welcome you in your new role as acting commissioner, being that is your first time before the committee in that role. So thank you for being here today, and if you will just introduce yourself for the record, and then you can proceed with your annual update for the department.
Great. Thank you, Chairman Meredith. As you mentioned, my name is Marnie Rock Gibson, and I am the acting commissioner with the Kentucky Department of Financial Institutions. Thank you for having me this morning, and I am pleased to give you a update about our, not necessarily our regional banks, but we're looking now at the community bank perspective. So we're kind of touching on all of those today. And in addition, I'm going to talk to you a little bit more about what the department does, because there are other areas that we supervise as well. So to start, let me get my PowerPoint up here. Okay. We're going to start with the depository institutions today, and I just encourage you to take a look at the PowerPoint. I'm not going to read every number to you because I know how thrilling that can be to have numbers read to you early in the morning, but I do encourage you, if you do want to look at these a little deeper, please take a look at our annual report that can be found on our website, and we can also give you a copy of that as well. It is public information. So generally, I just want to talk about our bank branches here in Kentucky. So right now, our state charters stand at just under 100. We have lost 2 additional charters this year, so we are at 99 as of today. You can see that we have a decreasing number of those banks that are under $100 million. Those are due to mergers. And that does sound negative on its face, but I want you to really focus on the third line that you see. And that line is our total assets. And despite the decrease in the number of institutions that we have, our assets are actually increasing. So a lot of those charter mergers that have happened are happening within the state, and we are retaining those assets, and our community banks are continuing to grow. Secondly, this is just a chart that's a little bit easier to take a look at than just those numbers, and this goes all the way back to 2010. And you can see the decrease in charters. On the left-hand side, we're looking at about just under 160 back before I started with the department, pretty close around that time, if I can age myself a little there. And then all the way down again to 101 as of the end of 2022. So what you really can focus on there is the number of institutions kind of on the bottom in that dark blue are ones under 100 million. Again, you can see that those are decreasing. However, you can see that our larger banks are starting to increase again, but the larger banks are, again, still our state chartered community type banks. And actually in 2021, the number of those larger institutions, so the one in the very light blue, did surpass the darker blue line. So we do have a larger concentration in those $1 billion plus bank area. And just to give you a few more stats, our smallest bank right now stands around $26 million. And our largest bank is around billion. I apologize, $7.5 billion. So you can see, again, the growth in that. We do have several banks now that are over that $1 billion mark. Moving on to Kentucky bank performance. This is one of my favorite charts to even talk about because you can really see a lot about Kentucky in comparison to our region and the way that Kentucky looks. And again, as I said before, I'm not going to point out every single number on this chart, but you can see that we're kind of somewhere in the middle in the number of charters that we do have. But I do want to point out our rankings, how we look in comparison to our, not only nationally, but to our kind of surrounding states or surrounding area. So we always do well in our net interest margin, as well as, and you can see on the side, I have some notes there, return on average assets, return on equity. But I want to focus on that last column. So we're looking again at your Tier 1 leverage capital ratio. This is something that I'm very proud to say. In all the years that I have been with the agency, I've very rarely not seen Kentucky at the top. We are very good in the state of Kentucky about preserving that capital. And again, I can only remember just a few times, really, despite kind of the volatile economic environment, Kentucky banks are continuing to be strong. And this is kind of exemplified by those numbers and where we rank. So this, again, is just kind of a sample. And I'll go into a little bit more detail now on Kentucky bank performance. So again, this goes back a little bit, gives you more historical data. So we're going all the way back to 2018 here. And you can see pretty consistent on the ROAA as well as on the net interest margin. pretty close. You can look at the chart. This is really a good chart to look at because it gives you, really, you can see the changes. But again, I want to focus on that line, the very thin line. That is your Tier 1 leverage capital ratio. And as you can see, despite even the more volatile economic environment, we have just continued to flourish in that area. So I'm very pleased and thrilled to continue to share that information. And I have taken a peek at some of our 2023 numbers, and that trend does continue as well. Now we'll turn on to our credit union branch. So we are looking at very similar in the number of state charters over the last several years. So those have remained relatively consistent, except for a lull there in 2021 where we did lose several of those. On this, I want to focus on our number of credit unions that are under 100 million. That number has remained pretty stagnant, and right now, again, we are still sitting at 12, and again, under 100 million on there. And I will have to look at my notes on the smallest one for that one, but I do want to share that. Our smallest one, there we go. I was to make sure I was correct on this. So our smallest credit union actually merged out. That was our merger that you can see there on 2022, but they did merge with another state charter credit union. So that is still being covered in the state. Our assets have remained, again, pretty stagnant. If you look at 2020 there's a little bit of an increase in assets and then pretty much stabilized. But in 2023, again, we're continuing to see that increase in assets within the state. And we're looking at asset size. And the key that I want to point out in this chart, again, goes down to the dark blue area. Our very, very small charters, those that are under $10 million, are merging out, and we do not have any of those left as of right now. So our credit unions now are looking at $10 million and above, and you can just see the kind of the difference in those. Our largest credit union right now is over $1 billion, and we do only have one of those right now. Now let's talk about credit union performance. So again, if you look at the chart comparison, if you look, for example, Illinois, there's a substantial number of credit unions in Illinois. So it's really hard to kind of compare those numbers when we only have 18. So I will say that while it does on its face look, for example, if you look at the ROAA and we're number 8 in that group, in reality, our credit unions are very good at serving their members, and that's what's important. They do pay healthy dividends, and that's something that we want to remember. So we don't necessarily look at these as negative because our credit unions are still stable and they are doing well. In fact, if you take a look at the little blue box in the corner, it says 100% of our Kentucky credit unions do have an asset quality rating of a 1 or a 2. And while I'm sure you're familiar with from previous presentations, I can't give you any details or share any of that information, but I can say that they do have a rating of 1 or 2, which again is very good and very positive for the industry. And then I just want to talk a little bit about what we do. Examinations. This is the core part of what we do in the depository area. And I won't go over every single one of these as I've mentioned before. But I do want to focus on the third line there. We are talking about information technology. As many of you are aware, information technology and cybersecurity has become a significant portion of what all of us do in all of our industries. So likewise, we have continued to focus on information technology. We are looking to enhance our exams in that area, and we have really spent some concentrated time at our banks and our institutions. And then at the bottom, I do want to note, I haven't mentioned trust companies yet, but we do supervise 4 state chartered trust companies as well. Those exams rotate pretty much in that every year. We go to 3 to 1 and then back to 3 and exam on 1 again just because of the cycle. So I just wanted to point that out, that we are doing those as well. And then quickly, I want to give you an update on our securities division. This is the second of one of the areas that we do supervise. And from a numbers perspective, this is a lot of registrants, and we license and supervise all of these registrants. And that's what I would point out mostly in terms of the broker-dealer and broker-dealer agent numbers. So we do have over 160,000 individual broker-dealer agents and firms registered in the state. The investment advisors. If you look at those investment advisor representatives that operate in the state of Kentucky, we are the only ones that actually supervise those. That's a significant number, and the SEC is not involved in that. So we do supervise those 6,400. And in Kentucky, we do have over 100 state investment advisors as well. And again, we are the sole regulator for those investment advisors. In our licensing and registration, this just shows the healthiness of Kentucky's economy, and that we have this. If you just kind of look at all these are all essentially different types of securities. So these are all investments that are happening in the state or opportunities for investment. The numbers generally tend to increase. Especially if you're looking at the Regulation D Rule 506 offerings, those numbers have increased a little bit over the last few years. I do think that last number is actually a little bit larger. It looks like it has gotten duplicated, so I apologize for that. I cannot imagine that those two numbers would be identical, but I do recall that has increased as well. So again, you can just see the healthiness of the economy as all these offerings are continuing to increase and grow in the state. For examinations, we have a relatively smaller staff in securities, and because, as I mentioned a few moments ago, we are the sole regulator for our investment advisors. So over the COVID years, we did really need to focus on those state chartered investment advisors and state registered investment advisors, because again, no one else was looking at them. So that's why our exams have been heavily focused on the investment advisor side. In 2023, we are already moving towards more broker-dealer exams, so we expect that to increase. And the bottom line there is just enforcement actions that did come out of examinations. And speaking of enforcement, I just want to touch a little bit on these numbers as well. So you're looking at our investigations and our examinations, and we did have quite a few of what we consider multi-state examinations where we were working with other regulators, hence that very large restitution number that you see there. These were many, many years in the making, so I know that number probably stands out to you as pretty significant, and it is, and this was restitution ordered for Kentuckians. And then lastly, I'm going to talk a little about non-depository, which is the third area that we do regulate. In terms of licensing, you can see, again, we have quite a few licensees. We're looking at over 12,000 just in 2022. I will point out the number of deferred deposit lenders has continued to decrease because of that moratorium that's in place. Now, I do want to talk about our mortgage examination branch. So we are increasing slowly our number of mortgage exams that are conducted. So we're looking at 88 in this year, 86 in 2021. Some of this is still a little spillover for COVID. We are now operating more in a hybrid approach to where we tend to actually go in, but we do some of that activity at home because it does save resources and it's more positive for the industry. And this is all across the board. We are implementing a hybrid approach, but we do firmly believe being on site is very important for many reasons, including we want to be a resource to those that we supervise. Non-mortgage examination branch. As I mentioned earlier, we talked a little bit about that deferred deposit area and a little decrease in the need there. Consumer and industrial loans, we're trying to ramp those up a little bit, but because the law has changed, the exam cycle is now going to be more risk-based, which is what we really are trying to look for generally, is we want to do those risk-based exams and make sure that we are protecting Kentuckians. And lastly, the money transmitters, while the number has gone down, I will say money transmitter exams have increased in complexity, and while the number of exams has decreased, the number of weeks on site is the same. And if you think about money transmitters, I want you to think about those large companies. You're thinking about the PayPals of the world. And so we are out there conducting exams with other states. And then consumer protection branch. This is kind of the equivalent where I talked about enforcement earlier. So we did up to 75 complaints received cases opened. So as you probably know with most other areas, an economic cycle really changes the number of complaints that we receive. And when everything is going well, the complaints decrease. So some of this is a spillover from as some of the money started to flow out from the COVID relief funds, we started to see more complaints. And I see lots of nods. And so, yeah, I think you understand how that works. So again, much of our activity, much of our actions, much of what we do is really focused on the complaints that we receive in terms of enforcement, and those are very driven based upon what we receive, but we do conduct our own investigations as well. And that is all that I have. I know this has been a very long meeting today, so again, I have a very short update, and I did just want to show just our general contact information. If you have questions or concerns, or if your constituents have questions or concerns, please have them reach out to us, because we are here for the consumer protection piece as well, and we're always happy to provide information and share.
Thank you, Acting Commissioner Gibson. Appreciate that very informative presentation about what all the department does and all the different metrics there. It is good to see continuing that Kentucky still holds the #1 position in capital for banks. Yes. And continues to be somewhere middle of the pack in all those other metrics that you all track as well. I do have a question from Representative Bentley.
Thank you, Mr. Chairman. My question is on the Securities Division. If someone has a CRD number, do you get complaints on them that you handle, or just on licensing complaints?
Both. To answer your question, both of those. So thank you for the question, and I'm glad you mentioned that because that's something that we do like to share. We do take complaints on that. That CRD number is essentially a locator almost. It's something that connects to an individual. Anyone that is registered to operate in the securities industry will have a CRD number because that registration goes through a system. And as you mentioned, he says CRD number. For those of you who don't know, that's just a tie to that number. So we will absolutely take complaints on that, and we take complaints on those that are not licensed or registered as well.
Just a simple follow-up.
Right ahead.
Say you had a constituent that had a complaint, say they weren't explained what was in their accounts on their equities. Could they call you on that then?
They could absolutely call, and they can file a complaint with us, and then we are more than happy to look into that.
Okay. Thank you for your time. Thank you, Mr. Chairman.
Thank you.
Thank you. Seeing no other questions, we appreciate you being here, Acting Commissioner Gibson.
Thank you so much.
This time I'm going to turn the mic and the chair over to Representative Lockett, my co-chair.
Thank you, Mr. Chairman. You can proceed to the table, and please introduce yourself and proceed with your testimony.
Pull one chair up if you don't care, because Gary's coming up too. Thank you, Mr. Chairman, members of the committee, and appreciate everyone's attention for what has been a relatively long meeting today. I will try to be relatively brief in the comments that we have here at the end. Representative Michael Meredith, chair of this committee, and representative for the 19th House District, we have talked a lot during this interim about the banking marketplace and the financial institution marketplace. Due to the national bank failures that we saw last year, and also something that has concerned many of us who have served on this committee for a long time, and that is the continued decrease in the number of state-chartered banks and financial institutions in this state. As a part of that, when I became chairman, I started trying to meet with all the different industry groups as well as the regulators to discuss what we could do and how we might be able to make the situation a little bit better. And so we have three things that we're going to discuss before you, again, briefly today. The first one that we will talk about is an issue that I think is nearly fully developed. It's not a complete version of a draft bill, but it is in your packets today. We will talk conceptually about another much larger piece of legislation that we are working on and is a continued work in process. And then we will finally talk about something that has been an industry concern for some time now, but we are trying to figure out the best way to address that, and it's more of a conceptual discussion as a whole. At this time, I would like to allow my guests to introduce themselves, and then we'll move into those presentations.
I'm John Cooper with Kentucky Bankers Association.
Tim Shank, General Counsel, Kentucky Bankers Association.
Ballard Cassidy, Kentucky Bankers Association.
Gary Brody, Bluegrass Community Bankers Association.
So the folks who are here with me today represent the two major banking associations representing community banks in Kentucky. And I'll start again with BR 159, which you find in your packets today, which is an unlawful financial trade practices bill. One of the concerns that I have heard from bankers all over the state and consumers in the state is the continued solicitation from groups that are not associated with banks, who are appearing to be associated with banks. If you have been a part of a mortgage transaction in the recent past, you have probably very quickly after the fact received some kind of a solicitation, many times on a bright green or bright orange or bright yellow sheet of paper, that has the name of your bank or financial institution that took your mortgage plastered somewhere on that document. And as a banker, as a loan officer, I hear from my consumers, my customers, many times about those issues. They call and they say, oh, this is a notice. Do I need to do something? What do I need to do? And what I have to inform them is that is a solicitation that has nothing to do with the bank. We have not given your information, sold your information. We don't work with this company whatsoever. They have scoured public records in your county clerk's office, and they have just sent out a mass mailing to everyone over the last 30 days who has filed anything in the sense of a mortgage. And they are soliciting you for either a mortgage protection insurance policy, some type of life insurance policy, some type of home mortgage warranty, something like that. And so what is the second section of this bill is really related to that issue. And it is a way that banks and financial institutions, mortgage lenders can address that issue. And one, if that solicitation comes out, that person is going to have to place a disclaimer on there disclaiming that they are not associated in any way, shape, or form with that bank, financial institution, mortgage lender, whoever it may be, to be in compliance with the law. If they do not, then the bank would have the ability to sue for damages, and this will fall under the Consumer Protection Statute as well, so that the Attorney General could enforce those provisions through civil penalties as well, and one of the trade associations and banks could come together to create a class action against some of those companies as well through that process of enforcement. The first section of that bill also addresses the issue of folks who try to appear to be a bank without being chartered or authorized to be a bank. We have many, many different types of lenders in the marketplace these days who are not a chartered bank. And I think it is important as regulations for banks continue to be much more detailed and much more difficult for banks to continue to meet those regulations, that there be a bright line divided between who is a bank, who is meeting all those regulations for consumer protection, and who is not. And the first section of this bill would address those people who are not banks, who are trying to operate in the lending space or the deposit space, but are not an actual bank who has been chartered as a bank and is meeting those regulations. And so that is really the effort around the Unlawful Financial Trade Practices Act and how it would work. We are going to remove the reasonable person statute because now that we have in Section 2, because now that we have the disclaimer language in there, the reasonable person statute was pulled forward from the previous statute on that issue. Now that we are going to require a hard and fast disclaimer, we don't think that's probably necessary at this point. So that on Section 2, on bottom of page 3, 3BA will likely be removed before you see this bill again during the session. And we will continue to work on hopefully seeing if there's some enforcement that the Department of Insurance may be able to do with folks who are trying to sell these insurance or warranty products as well. That's one more thing that we are still working towards. That is kind of the end of that process. Does anybody have questions about that specific piece of legislation?
Thank you, Mr. Chairman. Any questions about that particular piece? I know we have a couple of questions. Representative All?
I'm not sure this section or that section. I do think it's needed. As someone who moved during the pandemic, I got a lot of those things, and I called my local banker, and he's like, "You should just ignore it all." So thank you, appreciate it. So I commend you on bringing this legislation. The civil penalties on page 1, 1,000 to 5,000, and then on page, I think it's page 5, it's also 5,000 again. I just wondered where those numbers come from. Are those kind of generalized throughout the rest of the country, kind of in line with what other people are doing, or where those originated?
I think, and I'm going to look at my drafter for just a moment, but I think those were in line with what we already had in statute for some of those penalties, and moving those forward into these new these new sections of the statute.
That makes a lot of sense. I'd encourage anybody when they're putting a hard number in statute to index it in inflation. That way we don't have to come back in 20 years and up the amount, because $5,000 is a lot today, but it ain't in 20 years.
That's probably not a bad idea, and many of those numbers I think have been there for quite some time without being touched anyway, so we will take that into account, Representative All.
All right, thank you, Representative. We have a question from Representative Bentley.
Thank you, Mr. Chairman. I agree with you. I think this is needed, Chairman Meredith. But as this may be a trivia, but as I travel the state, I see all these new credit union buildings, but no new bank buildings. Is there a difference?
There is a big difference in a bank and a credit union, Representative Bentley, and I do not want to disparage the folks in the credit union industry, but I will tell you the biggest difference. The biggest difference is that banks, whether they be state or federally chartered banks in Kentucky, pay federal and state income taxes, and credit unions do not. And so as you see this expansion, much of that is reinvestment back in because of the fact that they're tax advantaged and they're able to do that while banks are paying the full freight of federal and state tax burdens and having to make their shareholders whole as well. So that is a big bright line difference between credit unions and banks, is their federal and state tax treatment.
Well, the reinvestment back in the local community is great, but it seemed like there was a big difference there. Thank you, Mr. Chairman and Mr. Chairman.
Any other questions? All right. Well, thank you, Mr. Chairman. Is there anyone else at the table that would like to give testimony?
Got to go to the next one.
Go to the next one. Very good.
And then they're going to weigh in much more on this one. The second thing is also another bill request that we have in process, and I want to tell you a little bit about this process. This is a fairly significant update of our state's banking and trust statutes. We in Kentucky have not had a comprehensive review of those statutes since probably the 1960s is the best guess that we have been able to find. There were some fairly extensive updates in the 1990s, but very little has been addressed since those times. Overall in the 60s, and then some substantial updating in the 90s. And so this is a really broad look at the banking and trust statutes in Kentucky. And I had every intention to have a final draft of this bill by this meeting. And I want to shout back out to Senator Howell for bringing this up in the process of the morning, but we have had some significant struggles in finishing this bill for two different reasons, really. Those of you who have served on this committee or who have been around the banking sector in Kentucky knew the name Deborah Stamper very well. Deborah had been a long-time employee of the Kentucky Bankers Association as general counsel and operated in a lobbying role with them as well. I have known her since long before I was a member of this committee or long before I was a member of the legislature in my role as a banker. And Deborah tragically passed away earlier this year. We had been working with her along with Ballard and John as well. And so we want to recognize all of her efforts that she did to help us get to where we are on this bill, but all she's done for the banking industry in Kentucky as well. We do have able new hands with Tim Schenck carrying on that role now, and the continued work of Ballard and John too. But Deborah was a stalwart for the industry, and losing her was a big loss, not only for the industry, but for all of us and the work that we were doing here as well. On top of that, we've also had a change, obviously, at the Department of Financial Institutions. And so when you have a big change in the industry side of representation and a big change in the regulatory side of representation, when you're trying to tackle something like this in a comprehensive manner, it does slow the process down. And so we're a little behind where we wanted to be, but we hope to be close to finished by the time we get back here in January for session. I will just say much of this is technical amendments to update where we have come from the 1960s and the 1990s to today, whether those are changes in federal law that now preempt things that were in our statute, whether they are segments of the industry that are no longer active in Kentucky and those provisions now need to be repealed, updating the Financial Institutions Board for new industries that have been added throughout the regulation at the Department of Financial Institution, outdating banking code provisions like required banking holidays that were in statute. Many banks just follow the federal calendar or they set their own. Those are really outdated provisions at this point in time that we set those specifically in state statutes. And again, we continue to work with both industry and the regulatory side to try to make sure we don't have any unintended consequences in moving this rather large piece of legislation forward. There are some trust provisions, and I want to say to Tim, if he wants to outline a little bit about that, about the trust provisions that have been asked for to make us more competitive in the trust space.
Thank you, Mr. Chairman. Thank you, all committee. I talked to a number of our stakeholders that were state trust members, and that amendment would come to KRS 286.3-146, which essentially allows for out-of-state reciprocity for our state, expressly allows for our state chartered institutions for out-of-state reciprocity to go operate in other states. This has been as part of their action for a while, but this would expressly put it in statute. But the other portion of that would allow other states to come in with the limitation on their reciprocity. They could not be more restrictive than Kentucky and operate here. That's built off of Alabama Model Code 10A-2A-15.11, which in short says for states that are very restrictive on allowing other states to come in, they could not come in and take advantage of all of our opportunities within the trust space, but then say Kentucky Trust can't come and do the same things within their states. So you look at states similar like Florida that are very restrictive and not wanting other state chartered institutions to come in and do business there. It would be much harder for them to come in. In short, creating an equal playing field for all of those within the trust space to operate. We have all the trust companies on board with this. Believe this would create some real equities within operating there, and have been working with us hand in hand throughout this process.
Gary, if you would like to comment on just kind of the modernization bill at all, as far as your all's position, we'd appreciate that.
The association, Bluegrass Community Bankers Association, represents the smaller banks. And from that standpoint, I just commend Representative Meredith for all that he's done in bringing this legislation forward and getting it to where it's current and modern.
So again, mostly conceptual. You don't have a bill before you on that today. Again, I hope to have that for you early in the session, sometime in January, hopefully. Ballard may have some comments about this as well, but the last one is something that conceptually I think we all at this table agree is something that is important right now. In fact, Gary's president, Ms. Edna Hughes, testified about this in our first meeting, but Ballard wanted to talk a little bit more about it today based on some statistics that they have. But Ballard, I'll turn it over to you now for that portion.
Thank you, Mr. Chairman, members of the committee. Thank you, and I would like to start off by saying that Acting Commissioner Gibson actually deserves more of your admiration than you could possibly imagine because of what I'm getting ready to talk to you a little bit about. Our banking industry is built on a foundation of what's called the dual banking system, which quite simply is there's a federal oversight and then there's also the state oversight, and they're independent of each other. When properly staffed and trained, that's what makes the United States really the financial envy of the world. The Department of Financial Institutions in here in Kentucky, as you know, is a trust and agency account. And also, as you know, that means that the banks, securities industry, as well as the credit unions pay for their own examiners and oversight without any funding whatsoever from the state or from the federal government. Much like the industry pays for the FDIC insurance premiums with quarterly premiums to the FDIC. Again, if properly funded, this keeps the U.S. the place that you want to be keeping your money. We have a current problem here in Kentucky, and we're not funding the Kentucky Department of Financial Institutions in a manner that allows them to, in my opinion, properly function without just some demand on people's times is just unreasonable, I think. KRS 286-1013 states that the Financial Institutions Board is to review and propose competitive salaries for recruitment and retention. Now, they do that. They also submit that proposal to the governor's office, which usually is not always either denied or lowers those figures. And as a result, the department is currently running approximately 16% or 10 examiners short of a fully staffed examination force. Of an even more serious nature, of the 33 field examiners that we currently have, 10 have less than 2 years experience. I think as an ex-banker, I'll tell you that it takes anywhere from 7 to 10 years to really get an examiner that knows the ins and outs the way that they should. Why is it a problem that you have, 1/3 of your, or 30% of your force with less than 2 years experience? If the answer to that is pretty simple. As soon as we start getting them trained, think of us as the minor league team for the Cincinnati Reds. As soon as we get them trained, the federal agencies take them out of the State Department and take them to the OCC, the FDIC, and the Federal Reserve. In essence, we're training for the other team, to be honest with you. Now, the obvious question is, do we have enough money to cure that problem? And the answer to that is an emphatic yes. The KDFI currently charges banks and credit unions and securities and brokers, and in their account, in their TNA reserve account, they currently have about $5 million last time I looked. It runs as high as $8 million some years. If we could use that to bring the salary levels of our examiners to the place where it needs to be, then we can keep them. And the reason why I wanted to show you how hard it is to keep them is just throw at you some really quick numbers. To have a certified examiner in the state of Kentucky, we pay them $72,000. On the federal level, it's $81,000 to $83,000. That's not the hard part. It's when they become senior examiners. We pay them $80,000. FDIC pays them $98,000. The Fed pays them $121,000. When they become field supervisors, we pay them $80,000. The FDIC pays them $140,000, and the Federal Reserve $144,000. And the branch managers or regional managers, we pay $93,000 to, and the FDIC pays $212,000 to. So as you can see, there's really no incentive to stay with the department once you get your training in. And the FDIC, the OCC, and the Fed know that. And so they as well as the banking industry, to be honest with you, and other people, they come and get them. And unless we start raising those salaries up to the point where there's an incentive for them to stay, we're going to continually have examiners that are not equipped the way they should be to examine and keep our banks in Kentucky safe. As Assistant Commissioner Gibson pointed out earlier, she's done a Herculean job, as her predecessors have, in keeping the banking industry in Kentucky as solid as it is.
And I would just say very quickly on that topic, Acting Commissioner Gibson didn't know we were going to present that topic today. We wanted it to be very clear that that discussion was not an ask from the department. That ask is coming from the industry in this discussion, because we all know, me as a banker, them as folks representing banks all over the Commonwealth of Kentucky, that if we want to continue to have good bank examiners who are trained and understand the ins and outs of what they're looking at when they look at a bank's balance sheet, when they review loans made by banks all over Kentucky, that it is a key thing that those people have some experience and they're not somebody just coming in right off the street or right out of college, that are just seeing it from a textbook example and not an actual real world day-to-day banking experience. And so that is extremely important. Again, not an ask from Acting Commissioner Gibson or her staff specifically at the department. This is an ask that is coming from the industry. Again, it was mentioned in Edna's comments earlier in the interim. KBA wanted to talk about it specifically today. And so it's not very often that you have the industry asking for more money to regulate the industry. But we find ourselves at a time right now where we think that is a very important ask. Gary, do you want to say anything further on that topic?
No, I just think as Ballard said, it's very important that we be competitive, not only in the salary standpoint, but also with benefits that the Fed and OCC and FDIC would offer versus the state.
There is some model language you might mention as well that we'd like to put in there sometime at some point. You want me to
go ahead and mention that?
Yeah. There is, we as we were looking at this, we were trying to find out what other states were doing and how they were keeping how come they were keeping theirs and we weren't keeping ours. And we found some model state language that we would like for the committee to take a look at the appropriate time whenever we put a bill forth to try to help the department retain its examining staff.
Mr. Chairman, members of the committee, that is all we had for those three different issues. We are happy to answer any questions that committee members may have, but other than that was what we had.
Well, thank you, Chairman Meredith, and thank you to all of your guests that are here. We do have a question from Senator Howell.
That's dangerous.
Thank you, Mr. Chairman, and I never pass up a chance to ask a question to you, Mr. Chairman. But I do think it is important to kind of talk just a little bit. I don't want to put you on the spot too much, but why, it seems counterintuitive, but why it's important for citizens of the Commonwealth to have quality bank examiners come in and test it. You can make cynical comments about why in the world the bankers would want that all you want, but there are some very legitimate reasons that are good for all of us. Would you just touch briefly on those some?
I would say it's a twofold thing, and I will let the other presenters mention anything that I may miss. But one, it's important to, again, that banking ecosystem, that we have good dual regulation. Depositors want to make sure that their money is safe in a financial institution. And if we don't have a staff of bank examiners that can go out and do those examinations at the state level, then we're not getting that, number one. And number two, it's all going to fall back to the federal side. And I do appreciate the fact that we do have some state regulation in our community banks. That's one. Secondly, I think it's important that we have those experienced examiners. Much like I said, it's one thing to look at something from a textbook example or to look at the examination manual and make a decision on how you regulate a bank based upon that. But if you're just looking at that, you have no idea about what's going on in that community. What's the growth level in that community? What's the economy look like? Because Kentucky's very different. What's happening in your district far outside of the I-65 corridor or far in eastern Kentucky outside of the I-75 corridor is very different to what's happening around I-65 and I-75 right now with growth. And those risk profiles and the investment profiles of those banks in those different areas are going to be very different. And if you're looking at that strictly as an examiner straight out of training or straight out of college from a textbook example, you're going to look at all those the same. Whereas if you've had some experience looking at different banks and seeing what's actually going on around the state, you're going to be able to put some actual real-world knowledge into those decisions as you look at what's happening in those individual banks and those individual communities.
Senator Howell, I would tell you that the banking industry is one of the few industries, and this is going to sound very incongruent, but the banking industry is one of the few industries where we want our competitors to be as smart as they can be. Because the worst thing that can happen to a bank in any community is have a stupid competitor. because you end up doing stupid things, and that ends up hurting everybody. So the way to ensure against that is to have a solid, good examining team.
Can I have one
Yes, sir.
follow-up? Is the additional demands on the banking industry placed by cybersecurity, is that kind of enhancing our need to have better regulators in a deeper examination, or is that completely two separate things?
I think that continues to make the structure of regulation more complex. Certainly, FDIC and the federal agencies are leading in many of those efforts, but they're also looking at it as well at the state level. And so those folks who have those expertise levels, frankly, cost a little more money to retain.
Most everything trickles down to us from the federal level on some level. I just didn't know if that was something else we need to look at from potentially enhancing in this area. Thank you. Thanks. Thank you, Mr. Chairman.
Thank you, Senator. We do have a question from Representative McPherson.
More of a comment, I guess, than a question, and I talk back to the Secretary Examiner and Chairman, your comments. You know, I'm a real estate appraiser by trade. We only get dinged when the market goes down. When the market's going up, it's all good. The market's probably going to shift here a little bit in the next year or 2 to 3. And if I'm got examiners looking at my work and the banks, I want them to have gone through some of that time and gone through some of those cycles and understand that those are cyclical and you don't need to overreact on some of that stuff. And when we get questions about why did this appraisal look like this, or why did this, whatever it might be, whatever that portfolio might be, I want all the experience that I can to be looking at my file.
And Representative McPherson, I would just say we're already seeing those changes in the economy. I mean, if you look at, from an asset liability management standpoint in a bank, if you look at moving from historically low rates at 4 to 5% on a lot of commercial rates, even down into the 3s somewhere, to flipping those rates over a 1.5 to a 2-year period to 7s, 8s, and above, that's a big shift in the market. Hopefully, I think for our consumers and for most of our bankers who follow all these things, hopefully we're hitting the high end of that change right now. We'll see what the Fed does over the next few months, but we've seen a significant change. I mean, like I said, if you look at rates, they've almost doubled over a 1.5 to 2-year period, and that makes for a big change in managing your liquidity at the bank level. But it also makes for a big difference in the pocketbook and the interest being paid, the loan payments that are being paid by folks who are out there in the marketplace as the individual homeowner that may not have a fixed rate, or especially in the commercial marketplace where you have folks who have either balloon loans that may be maturing at this time, or have been developers who were doing construction loans at 4.5% and 5% and are now doing them at 8%. It changes the entire mix of what those consumers on the consumer or the business side are doing as well with their actual cash flow in and out.
I would also tell you, Representative, that you're under attack also from the federal agencies. They're wanting to take location and reduce the value of location in your algorithm, which means they're going to be increasing something else, and don't know what that is, but that's absolutely absurd what they're headed to now, but we're fighting that like crazy.
Go ahead.
Just a comment. Yeah, right back to what you said about the balloon loans and going back in and looking at what the market's doing and reevaluating and people not understanding that just because a house they think it always goes up. They don't think it goes down. And again, to your point, every day the feds try to box us in to a point of doing a report for us. To the point sometimes I say, well, if you were going to do the report, are you going to sign this? And you come down here and look at it, and then you tell me what you do. If you don't need me, then don't ask me to do my work. But it is going to be something that we continually, the market moves, and it's shifting right now, and we're going to have to make sure we don't have 08 all over again.
And you know very well, if you were to standardize everything from a federal standpoint, whether it be appraising, whether it be banking, think about the people that would be unserved completely. Because that's the beauty I would say, of the community banking marketplace in Kentucky, where you have bankers that actually know their individual community and their region and the area that they market in. They know what's going on there better than somebody in Washington, D.C. or Chicago or St. Louis or wherever they're coming to look at what's going on. And that is a really, really important part. If it gets down to just doing everything standardized at some point, then a computer can do it. You don't even need the person to be there to do that.
Very quickly, Representative.
Yeah, so my final comment would be they don't understand the $500,000 house at the bottom, because that just drives them crazy. Thank you.
Thank you, Mr. Chairman. And thank you again to all of your guests. And if there are no more questions, I will turn it back over to you, Mr. Chairman.
Thank you, Mr. Chairman.
Seeing no more business, I will take a motion to adjourn. We are adjourned. Thank you.